for joining us with this webinar today. A very, very special thank you for those who are joining from India. We know it's a little late in the day, so we are very, very grateful. My name is Abhinav Sood. I'm going to be your moderator for this evening. Joining me today as an expert is Kapil Dua. He is the Director of Financial Consulting at Sanam S4. And you all must have seen with the invitations that would have come to you. The topic of today's webinar is cross-border payments in the Indian context. We have ideated this webinar keeping in mind a lot of the comments that have come in from our clients, potential clients, and the challenges that they face when dealing with India on a daily basis for payments coming in and out. Keeping in mind, I would like to quickly summarize the focus of today's webinar. If you all can see a slide at your screens right now, the focus obviously is to talk about the financial, the tax and regulatory implications for cross-border payments. What we are trying to do today is to provide a generic overview of the key aspects for cross-border transactions, and our attempt today is to join the common threads that affect all these routine international transactions, whether it is payments coming out of India. Obviously, the key considerations that we would like to sort of summarize for you today is to look at what the banking requirements are, the legal requirements are. There are so many laws that are applicable for transactions, especially international transactions. So we're going to try and touch upon the relevant laws that affect international payments. Taxes, obviously, one of the key considerations for almost everybody, viewing this webinar out there. Documentation and compliances. I know a lot of people have come to us and mentioned to us that India is a very documentation and compliance heavy jurisdiction. So we're going to try and talk about the key implications thereof. I think a disclaimer is in order. Almost every set of transaction or a specific transaction has different implications that attract them. So obviously it's a sort of a difficult exercise for us to club each and every one of them under one umbrella, but what we've tried to do here is to cover all the macro points that you should keep in mind when entering into any transaction in India. And if there are obviously some payments that you are currently facing headwinds on, we suggest you get in touch with us, and we can do an analysis on that specific transaction itself. With that being said, I'm not going to take much time, and I'm going to hand the mic over to Kapil. Kapil, if you could immediately, just jump into and talk about the first section of this webinar, and that's inward transfers, that's payments into India. So over to you, Kapil.
Thank you, Abhinav. I think you have set the scene right up, starting with the inward transfers in terms of payments into India. So what are the key elements? I mean, what I think I should definitely cover and think about what are the inward transfers and what are the challenges faced by foreign companies, foreign businesses when they are making payments into India. So for example, they're making payment to the Indian vendors, Indian consultants, distributors, and even when they are transferring payments to their Indian businesses, like their Indian entities, subsidiaries, liaison office, branch office. What are the key elements? What are the challenges which they generally face? To start with, I would at least explain about what are the categories of payment, which generally you could see when a foreign company, foreign business institution making payments into India or transfer funds into India. So first of all, capital funding of the Indian subsidiaries or Indian liaison office, branch office. So most important, when you are transferring funds into India, it could either be towards the equity capital or towards the expenses of the Indian office, which is a liaison branch. And in fact, sometimes you have a private limited company or a non-profit institution. You would think about how do I transfer monies into India for the servicing of the Indian cost. I mean, to manage the working capital of the Indian business. Commission payments. So you would have agents, for example, my education clients, education institution, they might be paying payments to their agents or any other vendor working for them on commission basis, so making payment for commissions, payment to their lawyers, consultants, a vendor who are providing services, and some of my manufacturer businesses who are foreign businesses having, they are purchasing from raw material from India and thinking about how do I pay for purchases of components and products. So these are typical categories of payment we generally see, which come across as some sort of challenges when you're trying to make those payments of funds or transfer of money into India. So typically speaking, what are the key considerations for these transactions? I mean, obligation generally on foreign clients is to deduct Indian withholding taxes. It's very important to consider and even think about it, because when we talk and when we discuss this with our foreign clients or friends, and they say, I'm not liable to deduct any withholding taxes because I'm not your country, or the Indian jurisdiction does not apply to me. I have US entity, I have UK entity. Can I transfer payments directly into the Indian vendor account? Do I need to comply with anything in terms of withholding taxes? Simple answer is yes. The Indian tax law as it reads, it says any person making payment to any person resident in India is supposed to comply with the law by withholding taxes in India. I mean, we can in future slides, in few more slides going forward, I can talk about there are practical difficulties for foreign businesses, foreign companies to withhold taxes in India and deposit taxes in the with the Indian government. But law, as we read as it stands today, it required foreign businesses to withhold taxes while making payment to the Indian residents. Next point, which is important again, agreements or contract should be in place. So before you make payment to the Indian vendors, subsidiaries, or other offices, there should be a contract, which is important to have a contract for your auditors, for the Indian tax authorities, for the bankers. Similarly, those contract must be transfer pricing compliant contract, like on arm's length basis, if the transaction is between your related parties, like when you're transferring funds to the Indian subsidiaries, and those should be on an arm's length basis. A requirement to your bankers, so which is also important, that what should be the purpose. So when you're transferring funds into India, please remember when you're making an online transfer into the Indian bank account, whether it's towards your own subsidiary, do mention the purpose of transfer, because if purpose of transfer is very clear, say for example it is towards service income of the Indian vendor, it is toward the equity capital of your Indian subsidiary, then it is important to mention the purpose, because whatever purpose you will mention in while making the online wire transfer, it will replicate exactly same in India. An Indian banker will issue this certificate, which is called foreign inward remittance certificate, to the Indian vendor or Indian subsidiaries, which talks about the purpose. And that purpose is very important to the Indian federal bank to prove that the money has a legitimate purpose when it landed in India. So when you're making transfer, do mention the purpose, one of the banking requirements in India. Responsibilities for banking and foreign exchange cost, again, very important criteria or the things to remember, that who will bear the foreign exchange cost. Sometimes, I mean, from number of years, I would say, we face challenge when the foreign holding company transferring funds into India, which they are supposed to transfer, say 100,000 Indian rupees, say almost £1,000 or $1,800 towards the share capital of the Indian company. It is very important that the money should land in India in that form. I mean, if the money lands in India when you transfer in foreign exchange, if it lands in India less than 100,000, which means you need to transfer more funds, and if lands way above, say 120,000 Indian rupees, then you would need to refund. The Indian company who has to issue shares need to refund that money back to holding company. So very important that who is bearing the foreign exchange loss or gain here, and it has to be calculated very near to the actual cost or actual money which you need to transfer. Then one of the other most important factor here is the service tax. I mean, who is responsible to bear the VAT component. Like in India, we have a service tax, which in few other foreign countries we have VAT equivalent or GST, like goods and service tax. So in India, we charge service tax on services provided by the Indian company. So when an Indian company sometime providing services to Indian resident or even to the foreign resident, they might have to charge service tax. I mean, I don't want to get more deeper into it. There are some exemption rules for service tax for the foreign parties, but it is important to note down in your agreement when you have agreement with your Indian vendors, Indian service provider, who is responsible to to pay or to bear the cost for service tax for the payment of Indian government. So it's very important to consider, these basic elements when you're thinking about transferring funds into India. I mean, now going forward, I can definitely talk about the key consideration or the points to know that how do you manage these? How do you come out of these challenges when you are transferring funds into India? So, for example, when you are infusing capital, like when you're buying shares of your Indian subsidiary, it is free of tax. So sometimes you can take that as a model of providing working capital to your Indian business because there is no taxes when you're transferring funds into India to your Indian subsidiary in form of equity share capital. There are no taxes, but you do need to consider about stamp duties because whenever the Indian company issuing shares against, they have to say increase the authorized capital, and in order to increase the authorized capital, they have to pay stamp duties in India to the Indian company house. So one of the important elements which you need to consider, the foreign direct investment regulation related to that, what are the forms, post facto forms which you need to file after making those payments. And for example, you might be thinking, okay, it's easy for me. How do I transfer funds? Can I transfer funds in the form of loans to my Indian business? Whether I'm providing loan to my branch office, I'm providing loan to my Indian subsidiary, or can I provide loan to my liaison office? One of the, I would say on a macro level, consider loan as a restricted way of transferring funds into India. There are some sector in which you can transfer loans by following the external commercial borrowing guidelines. For example, for the infrastructure sector, for hotel industry, for mining sector, few other sectors which are capital intensive, and the government of India through the external commercial borrowing guidelines, they have allowed ECB, regulation so that you can transfer funds into India by way of loans, which has its own criteria and obligation to follow.
So, I mean, just for clarification here, would something like an interest-free loan or a moratorium on interest payments be allowed through this loan mechanism, assuming, of course, it is sort of an unrestricted sector?
No. So soft loans is something which you really need to consider well before even deciding about can we send monies to India because it's a related party transaction, and can I transfer that without interest? The answer is no. You do need to follow the ECB guideline, which says there has to be interest, which could be say LIBOR plus some basis point, say 200 basis point or 300 basis points. But there should be interest. It should be on an arm's length basis. There should be interest charged from that perspective. One of the other important perspective that you should definitely need to think about what are the services, whether those services which are provided by the Indian vendor are taxed in India or not. As I said in the last previous slide, that what about the withholding taxes? I mean, who's responsible to withhold taxes? If the foreign party making payment to the Indian vendor, can the Indian government go after the foreign provider, say, who's receiving services? Can they ask them or ask them to oblige to follow the Indian law to withhold taxes? Indirectly, yes. Even though the foreign company does not have a legal presence in India, I mean, they might have a presence in the form of liaison office. So then in that case, the Indian tax authorities can definitely ask the liaison office in India that, look, your parent has made a payment. How come they made a payment to the Indian vendor without withholding taxes? Practical difficulties which I was talking about. In order to withhold taxes, you do need a TAN number, like TAN, TAN number in India, which is called a tax reduction number. And in order to get a tax reduction number, you do need an address in India. So it's a practical problem because foreign companies do not have a address in India. They sometimes take tag number on the address of their lawyers, their CPAs, or their liaison office to withhold taxes. But as per law, withholding taxes has to be there by a foreign party when they're making payment to the Indian vendors.
And this practical difficulty could also come in when you're doing corporate tax payments, for example.
Yes. So even if you have, for example, you would like to file tax return because someone, which we can cover in the outward payment. So when someone has made a payment to you as a foreign company and they have deducted some taxes in India, and you are obliged or you are required to file your annual tax return because you want to claim the tax refund in your home country. So there is a requirement to file tax return. And while filing the tax return, you realize that you do need to pay more taxes in India because the person who deducted taxes in India, which is more we'll cover in the outward payments, but there is less taxes. So you do need to make payments of taxes to the Indian tax authorities, and you will find challenges of depositing tax directly on the Indian government portal because you don't have any India presence, because you don't have Indian bank. So a foreign bank is not allowed to make payments directly to the Indian tax authorities. So in that case, the solution is talk to your lawyers, talk to your consultants or service provider. Can they make payment on your behalf as a reimbursement cost? I mean, it's allowed for them to make those payments on your behalf. Some other difficulties, like when you transfer these when you specifically transfer funds or payments to India, you will end up having authorities problem, like for example, like I talked about the foreign inward remittance certificate. So this is the key. I mean, remember, whenever you're transferring funds to India, four basic elements, or I would say five basic elements, like date of transfer, foreign exchange conversion as on the date of transfer, the money transferred, from where it is coming, and the purpose of transfer. These five elements are written clearly by the banker in India who is receiving payments on behalf of your vendor whom you're making the payment from overseas. The banker will issue the FIRC, the Foreign Inward Remittance Certificate, to the person in India or a company in India who's receiving funds, and that FIRC is like a Bible. Is like will become a document in place which will prove that the money has come from the legitimate resources. It is come. It is not a money under black money, or it is from proper sources from overseas. What was the purpose? So this is also very important from a FIRC point of view, that when you're making payments, do clearly write down the purpose and the amount which has been transferred into the Indian vendors. Specific set of transactions. So, for example, when you are transferring funds in the form of equity and borrowing, as we have talked about, there are some sort of guidelines and timelines which you need to follow. So, for example, when you receive funds, when an Indian subsidiary receiving funds from the holding company or a group company towards the equity capital, so the Indian company who's receiving funds is required to file the RBI, the Reserve Bank of India, intimation within 30 days of receipt of funds that they have received funds from so and so sources on so and so date, which are the timeline and guidelines which you need to follow, and the Indian subsidiaries do need to understand and educate even the foreign holding companies when they are transferring funds into India. The last but not the least, and I would say most important to our clients and friends who are into the non-profit institution, education institution, primarily overseas, who would like to set up a non-profit organization in India. But do remember, when you set up a Section 8 company, which was earlier Section 25 under the existing previous company law. Now it is Section 8, or you even set up a trust or a society in India. When you transfer funds into India, you do need to follow the guidelines of for FCRA, the Foreign Contribution Regulation Authority, which clearly talks about that unless you have a track record of doing 3 years of charitable education, the specific purpose for which the entity is set up, unless you have a 3-year track record of demonstrated that business, you would not get the blanket approval for transfer of funds into India, for transfer of even share capital into India. So even if you want to transfer the initial paid up capital of the non-profit company in India, you still need the FCRA approval, which itself takes 6 months or 9 months or even more, depending upon the business, depending upon the promoters, depending upon the profile of the holding company. So remember, when you set up a non-profit, you do need FCRA registration, like the approval from the FCRA authorities, even to transfer share capital for each and every project. Like if you have, say, you got the first approval to transfer share capital, next time you fund the Indian business for within the next 3 years, you still need the project-based approval, unless you complete 3 years and you go for a blanket approval. Very important, these consideration and the points noted down to inward transfers into India.
Yes, and for those who need to understand more on not-for-profit, is usually had a separate webinar on this topic as well. So it's a very detailed topic, nevertheless. Questions are coming in thick and thin. I'm just going to take a couple before we move on to the next section. We have some paucity of time, obviously. You mentioned in your previous slide that you require an agreement. So one of the questions that has come in is basically, can I pay ad hoc costs to my vendor without an agreement?
You can. I mean, there is no harm in paying ad hoc payments if it's just one-time payment in a year. But if it's a regular payment, your auditor, the Indian tax officer, in fact, if you are in UK, for example, HMRC, they will ask you at some point of time, show me the agreement, because you are ending up paying more than once a year, or say 2 times or 3 times a year. So it is advisable to have an agreement, but if just an ad hoc payment, it's fine on a basis of invoice.
We have a few more questions that are coming in. What I'm going to do is I'm going to take that at the end, if that's okay with everybody, and we're quickly going to move on to the next section. Kapil, can you now take us through sort of the other side of the table, so to speak? Can you talk about outward transfers now?
Yes. I'll say it's more difficult. I will say it's definitely restricted. Any country, I mean, India is definitely, we are, our rupee is depreciating day by day. So easiest for the Reserve Bank of India to keep more dollars in India and restrict the payments going out of India. So we are still not very liberal for payments coming into India, because we are worried about the money laundering and black money coming into India. But going payments out of India is even more restricted. So what are the typical categories of payment which I see, which we generally see when the payments are going out of India? So for example, reimbursements of cost to the foreign businesses, foreign holding companies, group companies, management charge as again to the related parties when the foreign company or foreign employees are working on some projects which have been being revenued or invoiced from India, and they want to charge the management fee which they have work on the Indian projects. Dividend payments, so again, dividend which the Indian company has earned and going overseas. Royalties for fee for technical services from the Indian subsidiaries, Indian businesses, Indian joint venture partners of yours who are making payments for royalties, and payment for purchases when you are importing from India. So you do need to make payment for those purchases. These are a few categories of payments for which you do need to make payments out of India. What are the key elements? Quite similar to what we had in the inward payments coming into India, but important. For example, agreements. Like you asked me, Abhinav, is it fine for just make the payment on ad hoc basis? But when the payment is going out of India, I would say it is more important to have the agreement in place, because the Indian CPA who's issuing the certificate, whether the tax is liable to be withheld in India for making that payment when the tax authorities is reviewing those payments. So it is important to have the agreement, even if it's a 2-page or 3-page agreement. But important that you have the agreement in place, which talks about the scope, which talks about who's delivering what, the delivery dates. So agreement is definitely important. Custom bills, I mean the full documents when the goods have been, for example, going or gone out of India, and when the payment is or when the goods are coming into India for which the payment is going out of India, bill of entry, when the goods landed, how many custom duties, all those custom documents are very important in order to make the payment. To give you an example, I mean, there are also timelines. So if you are making a payment for imports by an Indian company, you should better make the payments within a year, like maximum 365 days. There are guidelines to make the payment within 180 days for the imports into India, but maximum you can take by giving some reasoning 365 days. If you take more than that for the imports and for the services, then you do need to seek special approval from the Reserve Bank of India. I mean, if it's between 180 days, your banker is easy to process the payment with documents, of course. And within 180, 365 days, you do need to file the reason. But after 365 days delay on any import payments, you do need to go to the Reserve Bank of India for specific approvals.
Is it because it again becomes sort of a borrowing or a loan and therefore attracts RBI restrictions?
That's a very that's a good point, because Reserve Bank of India or the Indian authorities very likely assume that you have provided some sort of soft working capital to the Indian business, because you, in this way, the Indian party has not given the payment or made the payment within 365 days, because so this is some sort of indirect way of providing soft working capital, soft loan to the Indian business. So avoid such situation where delays in the payments are happening. In terms of the withholding tax requirement for the payments going out of India, again, 3 key elements, I would say, or even 4 key elements which you should definitely think about before any payment are going from India. So first of all, is there withholding taxes applicable on those payments which are going out of India or not? So Indian chartered accountant, Indian CPA would ask agreements, would ask the nature of transaction, and he is the right person to assess whether there is any withholding taxes applicable on that payment which is going out of India, whether those income which are earned by a foreign business and going out of India, like royalties, fees for technical services, and withholding taxes are applicable or not. So there has to be assessment by the Indian CPA. Tax registration for the foreign party, like in India we call it PAN number, which is a tax number as per the Indian tax requirement. So if foreign company or foreign institution have a PAN number in India, the withholding tax rate goes lower. So if you have a PAN number in India, the tax rate goes to 10%. Otherwise, it might go up to 20% or 25% in some cases, where if you don't have the PAN number. If you have a PAN number, are you legally required to file the tax return? Answer is no. But if you have earned any income from India and those income were subject to withholding taxes and someone has deducted taxes in India on your behalf and given a certificate to you, then you are supposed to file the return. Just by applying a PAN number and having a PAN number, it's not that much required. I mean, if I read the clear law, it says anybody who's having a PAN number at least file the nil return. But you as a foreign business, if having a no return from India, keep on filing the return is definitely the prudence to go for. But it's fine. I mean, I have never seen in the last 15 years that the Indian tax authorities going after the foreign businesses just because they have not earned any income in the last 10 years and they're not filing tax return. If you've earned any income, if you have any withholding in India, do file. Please file your tax returns. Tax residency certificate. So you need to, as a foreign business, foreign company, foreign institution, you need to apply a tax residency certificate from your home country inland revenue authorities, which will give you a one-pager certificate, for example, that you are a tax resident of, say, US, UK, and your home country, to claim the benefit under India and your home country tax double taxation avoidance agreement. It's primarily because Indian law clearly talks about the requirement which came almost 3 years back, that in order to give somebody a benefit of the DTAA, the double taxation avoidance agreement, it is very, very important that the foreign company, foreign business do demonstrate that they are tax resident, taxpayer of their home country. And last but not the least, which I would say most of our, the foreign businesses which we deal with, the very easy or very typical question they come and ask me, why there is a declaration asked by a foreign, asked by an Indian vendor or Indian subsidiary when we are making payment to them for services, or when the payment is going out from India, that we do not have a permanent establishment. Like a foreign party has to give a declaration under a specific form prescribed by the Indian tax authorities to declare that they do not have, like foreign party, do not have a permanent establishment in India. So permanent establishment is a bigger issue. It's a definition which is given in the tax treaty between the India and the home country of yours. So you can definitely go and read that definition of permanent establishment. And we can definitely talk. We have covered this issue in our previous webinar, and we'll keep on covering because this is one of the big issue for the foreign businesses. But this declaration of having no permanent establishment is very important, because if you have or if you do not provide this declaration, the tax rate will go to 40% on all the profit which you earn from India, and also you do need to prepare books of accounts in India, even if you don't have a legal presence. So giving this declaration and sign this declaration is very, very important, and assess whether you have a permanent establishment in India. So few key elements. Again, like I've covered in the inward payments, some of the key points, noteworthy points to cover about the outward payments are, primarily speaking, for example, for services, withholding taxes can be claimed back in your home country. So it is very important and consider and think that even though the withholding taxes have been deducted in India, you can claim back those withholding taxes in your home country, provided there is a tax treaty between India and your home country. So for example, we have very good treaty with US, UK, Singapore, Mauritius. Like, we don't have tax treaty with Hong Kong. So if your holding company is in Hong Kong, you would not be able to claim the credit back of this tax that has been withheld in India.
And can I simply go and take a refund from the authorities there?
No, sadly, unfortunately, no. So again, very good question. I mean, it is important to think that if your foreign business is liable to pay tax in your home country, then only you are allowed to take a credit. Now, if you're a foreign institution as a non-profit, you are anyway not liable to pay taxes in your home country. So this withholding taxes, which has been deducted in India before making payment to you, then this is a waste tax for you, because you would not be able to take a credit because you don't have any output liability of tax in your home country, being a non-profit. So it's very important perspective to think about it, whether you have any output tax liability in your home country or not. Imperative to understand that what are the transfer pricing regulations and provisions for output payments. So it is important, like I said, there has to be an agreement. So when there is an agreement between two related parties, you do need to think about transfer pricing regulation. How much margin you're keeping in India, how much margin you're keeping in overseas foreign holding company or group company. So transfer pricing plays very important role, because that is an agreement which definitely your CA, your CPA in India, who is responsible to give you certificate for making payment on overseas, would ask you a transfer pricing agreement. So even before you know that there could be in future, there could be relationship between your Indian subsidiaries, Indian business with the foreign company, do think about the transfer pricing agreements and transfer pricing regulations. Imports. So, for example, for imports between related parties, I mean, some of our clients, we do advise them, do not send your goods into India to your Indian subsidiaries unless or until you have a special valuation branch order. Because sometimes what happens when you transfer goods, so for example, your Indian subsidiary is in the trading business, and Indian subsidiary is importing goods from you to sell those goods in India, and when the goods travel from your overseas holding company to Indian customs, and for the benefit of the Indian company to resell in the Indian market, the Indian custom office will not easily let those goods out of custom office. He will say, since it's a transaction between two related parties, so there is higher chances of you controlling the price. So he will say that, look, you do need to go to a special branch, like special office of customs, which is a special valuation, and you do need to file the application for the arm's length valuation of those those goods which are lied in customs. So a very simple basic advice: whenever you transferring your first consignment to India, do transfer a very less amount of quantity and in terms of price, so that even if the goods are stuck in India at the Indian customs, you are not ending up paying high demurrage, and this is not a high sensitive goods and not a very high volume and quantity. And in the meantime, do think about, even before transferring, what would be your application for the special valuation branch before transferring your goods into India, because those are the prime important factor before making payment for those goods out of India. In most cases, what we have seen, the custom liabilities must be taken care by the Indian buyers. So, for example, custom duties, declaration for those custom goods. So everything should be covered in your agreement, that these are the responsibilities of the Indian buyers. Banking requirements, like I said previously also. So, and Reserve Bank of India guidelines, for example, when a payment is supposed to be made from India, the Indian company who's making the payment would need to go to their CPA, who will give the certificate under, say, Form 15 CA and CB, which talks about whose payment is going where, money is going where, why the money is going, how much taxes, is, if applicable, has been deducted, if the taxes have been applicable, whether it has been deducted and paid on time or not, what are the certificate of those payment of taxes, and filing the Form A2, which means that declaring to the Indian Reserve Bank of India that the foreign exchange has been bought from the open market or from the forex, like a foreign currency bank account of the Indian company. So there are important documents which need to be filed with the Indian banker. Form A2, 15 CA, CB certificate, a copy of the agreement, copy of the invoice, very basic documents which need to be filed with the Indian banker.
And so are these across the board same for all banks? Would it be safe to assume that irrespective of who you're banking with in India, it is these 4 or 5 basic requirements that can meet every banker's requirement?
It is definitely, it is one of the basic requirements, these 4 or 5 elements, but sometimes we have faced challenges with different banks, whether Indian bank or foreign bank, because the relationship manager or the team which you're dealing with, they are not updated with the new any changes in the Form A2, for example. Changes in the requirement from the Reserve Bank of India. So sometimes it's easy, or it's advisable to consult the Indian advisors, Indian lawyers, Indian tax consultant, that what the banker is asking are the correct documents or not. Then we can definitely talk about the bank charges and forex debited. So it's important to write down in your agreements when the payment is going out of India, that who is responsible. Who is responsible, whether the foreign party, foreign business, or the Indian party, Indian vendor is responsible for bearing the expenses on the bank charges. Similarly, non-profit organization, again, outward transfers, I would say no. So don't even think about sending monies out of the non-profit Indian entities like Section 8 company or trust, because the basic purpose of setting up a non-profit institution, non-profit entity in India is that you would not be paying any taxes in India. You do need to apply for certain tax exemption under 12G, 80G, 12A or 80G, and those certificates are valid subject to that the money has been spent in India. If you try to transfer funds to overseas, you might be having a risk of tax authorities withdrawing the exemption, the tax exemption which they have given to you. So it is very, very difficult to transfer funds out of India from the non-profit institution. So whenever you set up non-profit, think of always using those monies for the Indian payments corpus. If you're not able to, spend the whole money in a year in India, maybe transfer 15% as per the requirement to the corpus fund, but try to spend 85% in India from that perspective.
So let me just stop you there. We've got a question right now, and basically to summarize the question, what the person is asking us is that do even education service providers need a tax residency certificate if a vendor in India wants to deduct TDS on them?
Yes, I mean anybody, when the payment is going out of India, tax residence certificate is must. Whether you're non-profit, whether you are institution, whatever the setup you have overseas, even a trust, even a LLP like limited liability partnership, you do need a tax residence certificate. I'm just trying to sum up in the last point on this slide is primarily speaking, just to cover, there could be a remote chance that your Indian business, like Indian subsidiary, could be you might be thinking of creating the Indian subsidiary as the Asia Pacific hub. So, for example, your India subsidiary could be a holding company for your subsidiaries, further down level investment in Asia, like Pakistan, like Bangladesh, and few other regions in SAARC regions, Nepal, where those subsidiaries are funded from India. So whenever the payment is going from the Indian company as equity capital for the further down level subsidiaries in other regions out of India, then those have to be as per the overseas direct investment regulations of India. So, for example, an Indian company can invest up to 400% of its net worth to an overseas business, like overseas subsidiaries. And there are furthermore regulation like what kind of business they can do. They cannot do gambling, they cannot do real estate trading, and few more restrictions. But from a payment point of view, you do need to understand what are the restrictions, primarily when you're transferring funds from the Indian company for subsidiaries overseas, when they are when the Indian company is becoming a holding company.
Right, great. So a lot of compliances there. Just let me sum up, and maybe some bad news for not-for-profit organizations. But what we are trying to do here is just to summarize each and every aspect. Obviously, there are solutions attached to it. Everything has a detailed analysis that requires. So in case you have any such questions which are specific to your transactions, please do write into us. Uh, we are running short of time. We are just about 5 minutes to go, but I'm just going to quickly take a few questions and pick your brains on some of the aspects that I've just seen come up on the screen. Number one question that I've just received is that can I make payments to an Indian vendor on behalf of my Indian subsidiary?
I would say avoid that. I would say do not make payments to even foreign vendors, Indian vendors, directly from your foreign bank account on behalf of your Indian subsidiaries. Because it is important to understand that we have this law about withholding taxes. So a person making payment to another person, who's resident of India, so the payment should be withholding tax deducted, right? So when you're making payment on behalf of the Indian subsidiary, ideally speaking, you should again withhold taxes, deposit with the Indian government, even if the payment is made to a foreign party. Like, for example, we work very closely with a lot of our clients who have global contracts with, say, Big Four, like EY, and they are making payment to EY US directly from the US company on behalf of their Indian subsidiary. So typically speaking, they should withhold taxes even if the payment is made to EY US from the US bank account, if they want to book this expense in the Indian books of accounts. Otherwise, if the withholding taxes has not been deducted, so this expense cannot be allowed to be booked in India.
And obviously, we come back to your separate point on the practical difficulties regarding withholding taxes for foreign payments. So again, this question becomes sort of a redundant question. It's a no-no for them to not withhold taxes because they have practical difficulties in depositing them, correct?
Yes. So whenever you have the possibility of apportioning the global contracts and ask the Indian company to make payment for that contract, I know it sometimes becomes very difficult because you have negotiated a global contract with, say, FedEx, for example, who's your global provider for couriers or for other transfers, and you want to make them one payment for all your international subsidiaries from directly from US account. I will say avoid that if you want to claim that expense, charge that expense to the Indian business.
One more question that we have is, can I make salary payments to our expat workers directly in India?
Again, I would say avoid that because it creates other risk as well. I mean, when you're making payments to by payroll directly from US to expats who are working in India, then you are creating the risk of permanent establishment, because it will be treated as that they are your still your employees of a foreign company and working on behalf of foreign company in India. So that means you are creating a permanent establishment in India. I would suggest, even if you second them to the Indian company, I mean, still for example, the employment contract sits with the US entity or UK entity, you second them to the Indian entity, but all the expenses related to those expats should be booked in India and paid through Indian company's bank account. That is the best way going forward.
All right. I have a question that I have to ask you, Kapil. A lot of our clients, come to us and say that why can't they simply transfer INR payments to their Indian subsidiary vendors, consultants directly? Why is it required? Because what happens is typically their bankers abroad tell them that, why don't you hedge your foreign currency with us, and we'll simply transfer the INR payments to India. And most of their consultants come back to the client and say that that's not possible. Why is that?
Uh, we do need to go deeper into and understand why the payment is going to India. So, for example, if the payment is going to India towards the equity capital, then one of the requirements of the Indian foreign exchange law that when the monies are coming from overseas, it should come in the forex. I still don't want to go much deeper in the gray areas, because if I read the Indian law, foreign exchange means Indian rupees also, because it is a foreign tradable currency. But when I go to the service tax law, when I go to the VAT law, when I go to the company law, it nowhere says I recognize Indian rupees as a foreign exchange. So I would go and avoid that situation, that when you are transferring funds into India towards the equity capital, transfer funds into the foreign currency. That's one. When you're transferring funds towards the income of the Indian company, for example, the Indian company is on the basis of cost plus model, and you are funding the whole business of the Indian company, then you fall into the category whether the Indian company is charging service tax on the cost which they are invoicing to their foreign holding company or not. If they are charging service tax, you're free to invoice, and you're free to send monies into the Indian rupees. But if they are saying they're not charging service tax on the invoices raised by the Indian company on foreign company, and the money has been transferred from foreign company to the Indian company without service tax payable to the Indian government, please send monies into the foreign exchange, because the Indian service tax law is still following a definition that Indian rupees is not foreign exchange. So money has to be in US dollars or foreign currency. I mean, the important aspect which needs to be understood, how do the service tax authorities will find out that whether the money actually landed in India in foreign currency? By looking at the FIRC. So if your FIRC, even if you transfer funds in Indian rupees, but if the FIRC says that when the money landed in the Indian bank account, landed in foreign currency, you're fine. So there could be a middle banker who's converting the funds somewhere in India, somewhere in UK, or anywhere in the world, and he can demonstrate that when the money left from US, left in foreign currency, when it landed in India, landed in Indian currency, and he can rightly make on that FIRC showcase that the foreign currency was involved, you're fine.
All right. We're terribly out of time. We have a couple of more questions, but I'm so sorry. We are going to respond to you via email. In case you have any clarifications, you have our email IDs on our screen, and you can write into us, and feel free to ask any question that you have related to this or any other topic. So if I could just summarize this presentation, thank you so much, Kapil, for talking about all these aspects in details. We know each and every point that you mentioned is sort of a subject in its own, but there are a lot of do's, there are a lot of don'ts, there are a lot of avoids, and all our customers and clients who are dealing with India on a daily basis need to sort of take cognizance of all these points on a sort of holistic basis, and then proceed accordingly. So once again, thanks a lot, Kapil, and thank you so much to all of you for joining this webinar today. And please, we will get back to you via email for all the questions that I missed today. And in case you require any clarifications, please do write into us. So thanks, everybody. Thank you for those who are watching in India. It's almost dinner time right now. We shall see you again with another topic very soon. Thank you.
Thank you very much.
Thank you.